Good morning and welcome. Today is Thursday, April 4th. I'm Jeff Hughes, Chief Investment Officer at JWH Investment Partners and founder of Alpha Insights. And this is your Daily Five. The Daily Five is the show where we discuss the five charts that are really top of mind for us this week. First thing I'd like to do is actually just give everybody a quick heads up that we will be publishing the next issue of Huge Insights, the big picture, on Saturday, April 6th. That's this Saturday. For those of you who don't know what we're talking about, we do publish an investment newsletter every month that comes out on the first Saturday of each month following the NFP report, which will be out tomorrow. The newsletter is affectionately titled Huge Insights, the Big Picture. Therein, we discuss key macro factors affecting the economy and the markets. For those who want a little bit more, we actually have an upgrade to paid option for as little as $12.50 a month, which includes our monthly market forecast and positioning recommendations. A lot of times when people read the free portion of the newsletter, they'll come back to us, hey, Jeff, I love what you had to say, but how do I put this to work? How do I take these ideas and actually implement them in our portfolio? And what we've created this option to upgrade to paid so that those who want more can get more. And we provide very, very specific information, very detailed forecast on the S&P 500 and the broad stock markets at large, as well as many other asset classes. We go through our asset allocation tilts and our positioning recommendations, including very specific ETF and stock recommendations. So that's something that you can get if you're interested. Paid subscribers actually also receive an institutional report that we publish each week called Alpha Insights Idea Generator Lab. This details our top actionable trade idea and also provides a weekly update to our market commentary and gives a little bit of indications regarding sector rotation as well. And we also provide some privileged access, interim bulletin reports, and quarterly video content for paid subscribers as well. So there's a lot of value there for $12.50 if you're interested. Okay, enough with that. Let's jump into chart number one. We've titled this chart, Stocks Post Extreme Vertical Ascent. What are we talking about here? Well, both the S&P 500 equal weight and the Nasdaq 100 equal weight indexes have experienced an unusually rapid ascent of about 27.6% over a 105-day period from October 27th, their lows, to the March 28th high. But even the much broader Value Line Composite Index saw a rise of about 23.5% over the same period. Value line right here is indicated in green, whereas the Nasdaq 100 is in blue and the S&P equal weight is in the red lines. You can kind of see how all of them made this big push up in the first 2 months following the lows on October 27th. They topped just around the end of December there. The majority of this ascent was actually achieved in this first 60-day period here. What we've seen since is, and I say this because many out there have been heralding this phenomenon as being, a bullish broadening out of the market. And that, of course, has been true through those December highs. But since December, actually since the first of the year, we've seen the exact opposite occur. We've seen the Nasdaq 100 take off, whereas the value line, which is the equal weight index of the 1,700 largest stocks in the U.S., and that includes many small cap issues, that has actually lagged behind that Nasdaq 100. The S&P 500 kind of right in the middle, and so these are all equally weighted indexes. And so the thing to understand here is that it is all stocks participating, but there has been a narrowing of the market over the last 3 months. That narrowing suggests that we are at the end of a move, not the beginning of the move. That tends to happen when institutions are using the strength to sell out of positions that they do not consider to be of high quality or high caliber. In other words, we're seeing a separation of the wheat from the chaff here, and that tends to happen toward the end. The other thing that I would say about this is that this vertical ascent has kind of pushed stocks to a point where we are kind of in the clouds, so to speak. And with that, I want to kind of jump right into chart number two. Chart number two is entitled Valuations Are in the Clouds. And what do we mean by that? Well, they're extremely high. While prices have moved up sharply over the past 5 months, 2024 S&P Op EPS estimates have quietly moved lower by about 1.8% over the same period of time. So the S&P 500 index, this is the cap-weighted index, the benchmark, if you will, is currently trading at a very lofty 21.9 times a very optimistic consensus forward 12-month S&P operating EPS estimate of $240. Now, that's down from $245 back on November 1st. So to my earlier point, that 1.8% decline is the move from 245 to 240 over the last 5 months in terms of estimates. Now, a lot of people are pointing to the fact that financial media is suggesting that more companies are beating S&P 500 estimates in the fourth quarter. Well, that's because the estimates came down so much, and so they're beating much the dramatically lowered estimates. And we all know that Wall Street overestimates at the beginning of every year. We published a section about this in our most recent newsletter back on I believe March 2nd, and we also highlighted that fact in our last video. It's been over a month since we've been out on Stockcharts. We've actually been on a extended excursion overseas, kind of doing some trekking in the mountains of New Zealand. And so we've kind of been off the grid for a while, but coming back and seeing what has changed is kind of interesting to us, especially from a valuation perspective. Total market cap to GDP is now at 189%. Now, that, of course, is below the all-time record high that was achieved in 2022 of around 209%, but it's well above the prior cycle high, which occurred back in March of 2000, when that U.S. market cap to GDP ratio got up to around 143%. We're substantially above that level. The Shiller PE, the cyclically adjusted price to earnings ratio, actually closed out the month of March at 35.1 times. Now, again, the recent, I should say, high, this is the top that we saw back around the end of 2021, early 2022. We got to 38.6 times, but that is well above the historical average of about 17.5 times down here. And so, we're just, kind of coming up upon that recent cyclical high. The only time this ratio has ever exceeded that was back in March of 2000, when we got up to around 45 times on the Shiller PE. What Shiller does is he takes kind of a smoothing of 10-year trailing reported earnings, and he inflation adjusts those. The reason I think that this is a good valuation metric to pay attention to is that it's been consistent over time. And so what matters most is comparing today to prior peaks. And what we can say about today's valuation is it's only been exceeded twice in history. And the last time it was exceeded, which was late 2021, we had a 27% decline in the S&P 500 and a 38% decline in the Nasdaq 100 that followed over the subsequent year. The time prior to that was March of 2000, which preceded a 50% decline in the broad averages. So this should not be ignored. Importantly, if we strip away all of the accounting gimmicks that go into earnings estimates and just purely look at top line sales, okay, the price to sales ratio is 2.85 times right now. That is almost right on its all-time record high, which was 3.1 times, and that was achieved back in, I believe, early 2022 or late 2021, right before the most recent bear market decline that we were discussing. Dividend yield is also plumbing its all-time record lows at about 1.34%, and price to book is just off its all-time record high, which is achieved. That was 5 times on a price to book basis. That was achieved back in March of 2000. We're at 4.88 times. This is the new cycle extreme, and we should be very, very nervous because that is more than double the 2009 trough of 1.7 times. So the bottom line is that valuations right now across a broad swath of different measures stand at the 10th decile, the very top decile of historical valuations. And when we look at the forward 10-year returns that can be achieved from valuations in the 10th decile, the average return is 3.25%, and the median return is 4.1%. So when we say that, where we are is in the clouds, it's because, forward returns for the next decade right now are liable to be less for stocks than they are for the 10-year Treasury yield, which is currently around, 4.3%. So we think caution is warranted here from a long-term investment perspective because, we have studied this ad nauseum, and we have determined that the worst forward returns come from the 10th decile of valuations. And we are there, whether it's, PE, Schiller PE ratio, the price to sales ratio, the dividend yield, or price to book, or whether we're talking about more conventional sort of valuation measures based on forward estimates, or Warren Buffett's favorite measure, which is US market cap to GDP, which also is in the 10th decile. So this is something to be concerned about. Chart number 3. We know that we're in the clouds because advisor sentiment just hit a new 3-year extreme. This is Investor Intelligence Advisor Survey. John Gray has been doing this for over 40 years. He reads hundreds and hundreds of advisor newsletters and research reports. These advisors are people like ourselves. In fact, my opinion is included in this survey. And what John does is he takes a 4-week moving average of those responses, and he creates an index for that. And so we can look at a variety of different measures. I like to look at net committed bulls. Okay, what that is that's bullish advisors divided by the bulls plus the bears. So if we take those with an opinion, your opinion's either bullish or it's bearish, not, I think, neutral, or there might be a correction, some wishy-washy opinion. We want committed bulls plus committed bears, and then we divide the committed bulls divided by that sum, and we come up with the percentage of committed bulls relative to all committed advisors. And that came in at a 3-year record extreme of 81.6%. Okay, 81.6%. It's a level of committed bulls that now exceeds that which occurred back in July by a very wide margin, but also that which occurred back in November of 2021, which preceded a 27% decline in the S&P. Recall, this decline was only about 11% in the S&P, and the 3-year high, which led up to that, and that was this level right here, which was about 80.5%, and that preceded a decline of around, I believe, 8% or so. Going into that, maybe it was closer to 10 now that I think of it. But at the end of the day, I think what we can derive from this is the following. Readings above 70% in this measure have tended historically to coincide with major trend reversals. And secondly, while the bulls actually moved up to 62.5% as a standalone measure, that's the highest level since the summer of 2020. More important than that, I believe, is that the bears fell to 14.1%. And that's the lowest level that we've seen since January of 2018. That preceded kind of a short-term 10% crash in the market, as all may recall, when crypto was very, very popular at the end of 2017. And we saw everything kind of melt up in early January and peak right around the third week of January before, basically we saw a sharp 10% correction. So the recent bullish extremes that we've seen exhibited by this survey and many other surveys that we've been talking about for months now, and really delving into this, it really is, falls in stark contrast when you consider it in the context of the record level of insider selling that we have witnessed year to date. In the first quarter, it is a level that is unprecedented. And we're going to talk about a lot of these sentiment measures and what's going on with insider selling in great detail in our newsletter on Saturday. So look forward to getting a better view of what is happening broadly in terms of sentiment there, and how we should interpret that, more importantly. And in short, when we see extremes like this, we should be nervous, because it is a representation that everybody is all in on stocks at this point, and there are few left to buy. Chart number 4. The 10-year Treasury yield is on the rise. Recent hotter than expected inflation data has the Fed and the street, for that matter, now rethinking their rate cut forecasts. Over the last 12 months, we've seen GDP growth holding up much better than expected. Unemployment data has been holding below 4% so far. We think that could change going forward, as our work continues to point to an above average potential for a recession later in 2024. A lot of people are focused on how good things are right now, but they're always this good when the economy peaks. You always see the best data points at the highs of the economy before they roll over and before we see the recessionary data start to kick in. And we think we're on the precipice of seeing that. The street's initial forecast of 7 rate cuts in 2024 has already been downgraded to 3 rate cuts based on CME Group's FedWatch tool, and also looking at Fed Fund futures positioning. So those probabilities have been downgraded dramatically by the street, and they're more or less now in line with the Fed's initial thinking, which was, we're probably going to see 3 rate cuts, but more to the sense that it would be back-end loaded. And I think what the 10-year Treasury yield is telling us right now, and by the way, 10-year Treasury yields have been on the rise since late December, and that's despite Janet Yellen's, vocal preference for issuing new T-bills over T-bonds and T-notes. In other words, she's decided that she wanted to put the bond vigilantes at bay by focusing all new issuance of Treasury debt on the short end of the curve, so that there wouldn't be pressure on long-term rates. Well, despite the fact that that's what she's been doing, rates have been creeping up steadily. We got to a level of about 4.35%, which had held. That had been, pretty much key resistance, if you will, up until a few days ago, where we saw 10-year bond yields pop through that and get as high as, I think, 4.43%. Now we've seen a bit of a pullback. It looks like we're filling a gap here, but it's our suspicion that this is the resolution of a small degree classic pattern base formation of the inverted head and shoulders variety, which we've traced out here in blue. And the breakout above this level at 435 allows us to project a measured move up here to about 467. Now, 467 is important because that's the lower boundary of this gap that came into play back here in really late October, early November. with, I believe, a CPI release or something to that. Or I think it was the PCE deflator data that came out then that got everybody very, very excited. And then Powell's commentary supported the idea that we'd see some rate cuts, or at least that rates would not be rising soon. Well, that's been reversing. We've been seeing hotter than expected data in terms of the CPI and the PPI, which is a leading indicator to forward CPI readings. We've also seen the PCE and core PCE deflator data come in, on the high end of expectations. So, most people are kind of looking for, surprises to the downside in terms of that PCE deflator data, and it's coming in line. And more importantly, when we start to look at the super core levels, which are really focused on housing or services PPI, those are or PCE data. Those are the things that are coming in much hotter than expected, and those are going to have a much bigger influence on the data going forward. And so, the view at this point is that we need to start to be a little bit more vigilant about what forward inflation numbers are looking like. And this is suggesting that perhaps the Fed is less likely to cut sooner rather than later. And so, or more likely to cut later rather than sooner is probably the better way to put that. The other thing that I wanted to point out is that there's a larger degree pattern here, okay? If we kind of look at this whole pattern here as being kind of the handle to a larger degree cup and handle base formation, okay? That pattern resolved as well. And if it continues to resolve, we could actually get a retest of the old highs. The projection is up to about 492, give or take. These projections aren't, they're not specific. In other words, it doesn't mean that we can't exceed it. We can't go to new highs. It just means that, the supply and demand imbalance looks like the resolution of this to the upside would certainly likely carry it to 492, potentially even higher. We've got key resistance at 499 and a breakout above 499. All bets are off. We would have a rather big move of something in the neighborhood of 120 basis points that could carry 10-year bond yields up to around 620. I'm not anticipating that that's going to happen anytime soon, but the longer term forecast, which is not illustrated here in this chart, would suggest that Treasury yields have significant upside potential from current levels. And so as we see this price action confirm this bullish resolution, we'll be watching for a move here to 467, then 492. The bottom line is this. The bond market is telling us that a June rate cut is very likely off the table at this point, and it's highly probable that the entire rate cut, scenario is being pushed out either past the election or into 2025. We'll see. I think the one variable that could pull it forward would be if we do get the recession. Our recession models, and we have 5 of them, 4 of them are projecting a recession right now. One of them is neutral, but that neutral actually got downgraded to bearish. And so it's getting closer and closer to confirming recession. And so if we do get that 5th model triggering a recession signal, I think all bets are off. At some point, perhaps late second quarter, early third quarter, we could see GDP growth turn negative on a nominal basis. And so that's what I think the Fed would be worried about. If they saw that, I think we would very likely see the Fed react by cutting rates more aggressively sooner. But so far, we don't have evidence that that's happening. And so we need to be focused on the data. The data says, while the models are projecting that that's a definite probability mid-year, it's not here yet. So let's focus on the here and the now. And the here and the now right now can be observed quite nicely in chart number 5. And we've titled this chart, Follow the Yellow Brick Road. and it's a chart of gold. It's a weekly chart that goes back to 2009. 2009 is where we really kind of saw that initial breakout off of those great financial crisis lows, if you will, and a big push up to around 1900, a little bit over 1920-ish. We then had an 11-year period of consolidation where we put in this kind of large cup base, and that large cup base broke out, but it failed. And we put in what appears to us to be a large degree handle. And so if we look at this from a larger degree perspective, we've got a large cup and handle formation. And here's your neckline, if you will. And it seems to be, a strong right or a strong handle. If this were inverted head and shoulders, we'd call it a strong right shoulder because it's a little higher than the original point of the origin of the neckline. But all in, everything looks like it's moving according to plan with respect to gold. And why do I say according to plan? Well, as some viewers may recall, back on December 27th, in our 2024 Market Outlook interview with Dave Keller on the final bar, we highlighted gold bullion as our top actionable trade idea for 2024. It was at that time and remains our top actionable trade idea for 2024. And so how are we doing so far? Well, year to date, through yesterday's close, the gold is up 11.7%, and it's beating the S&P 500 over the same period by about 200 basis points. So again, we think this small degree base here, which is likely the handle of a larger degree pattern, projects upside potential to around 2550. So, we're just simply measuring, these highs versus this low, and a resolution above those highs gives us the ability to project a measured move to 2550. Okay, using that exact same approach, that measured move approach, from kind of the center of this cup and handle formation neckline here, we can project from this base to this center a move up to about 2800. So, if this larger degree pattern is operative, and we think it is, then the upside potential for the barbarous relic is probably closer to 2800. Now, I say 2800 as being, kind of a stretch target relative to our 2550, but it's not the only target. Using Arthur Scleroux's rule of 7, which is a way of projecting further upside when there's no further resistance. And Scleroux did exhaustive research across the entire spectrum of commodities using this rule of 7, and over, the empirical data really, which dates back decades when he was doing this work, I believe in the late 70s and early 80s. The data suggests that we can expect at least 3 additional upside targets beyond the 2800 target. If 2800 is exceeded, we can project a longer-term bullish target to 3400, then 4600, and then ultimately 8100 using Scleroux's rule of 7. So we think gold really is kind of the anti-paper asset, right? It's the insurance policy. People who are, and I'm just going to tab back here, use it, with respect to investor sentiment. We are at extremes in bullish sentiment right now, extremes toward paper assets, stocks and bonds, right? And we have what I believe is brewing a major sovereign debt crisis likely to occur on a global basis over the next decade. And this will be first felt at the individual level and at the corporate level. So personal debt, corporate debt will also be affected dramatically, and those will be the canaries in the coal mine to give us a sense of what's happening. But sentiment is so bullish toward stocks. Investors are willing to pay virtually any price for stocks, and there's no real fundamental basis, as we've talked about. Earnings estimates have declined going into the end of last year. But stock prices zoomed higher, right? Especially in the very first 2 months of that move, the biggest portion of the move, a 20% move up, while estimates were coming down almost 2%. Makes no sense. It's basically virtually the entire move is attributable to PE multiple expansion, which is another way of saying investor sentiment is expanding and becoming more and more optimistic. We are at optimistic extremes like no other. And so when we say gold is our top actionable trade idea, we're not so much investors in gold because we're excited about the big move in prices higher. We think that move in prices is going to be a consequence of something else. We think it's going to be a consequence of a debt crisis, which is brewing in treasuries, evident in this increase in yields as issuance continues to expand at almost $2 trillion annually as we run a 6% budget deficit that looks like it may be on its way to 7%. We'll see about that. Gold is the insurance policy. It's the anti-paper asset, and we think it will be the winning trade. Some combination of gold and cash. We're currently overweighting cash in our asset allocation because we think current yields on 3-month T-bills of over 5.4% is really, provides investors with the best combination of safety, liquidity, value, and yield. But gold is the hedge to a collapse in paper assets. And so we think investors should be increasing their exposure to gold and commodities in general. But we favor gold as an insurance policy against a potential recession that could evolve into a depression and a global debt spiral, which we think could really wreak havoc on the global economy and global currencies at large. So this is where we stand, and we're going to dig into the details of this view in our market analysis portion of the newsletter on Saturday. So for our paid subscribers, you can look forward to more on that on Saturday. For those who are not a paid subscriber, you may consider upgrading to paid to get a little bit more detail on that. If you'd like to reach out to us for any reason, you can contact us at our website, www.jwhinvestment.com. We're also on Twitter X. That's at alpha_insights. And then, of course, our newsletter is published on Substack. You can access our newsletter at hugeinsights.substack.com. If you're not on the distribution list, just subscribe, put your email address in there. It's free to subscribe to get the initial free portion of the newsletter. And if you'd like to upgrade to paid after that, then you've got that option later. So with that, I would like to thank you very much for your time and wish you the best luck trading.